Let me introduce you to Leo. Leo's been dabbling in the stock market for 2 years. So basically, in Wall Street terms, he's like a toddler who's just figured out fire. His portfolio's up 13% this year. He made a huge gain off a crypto meme coin. And let's just say Leo's feeling like he's basically invincible right now. Leo's hobbies? Well, he spends his evenings watching The Wolf of Wall Street, preaching to random strangers about the next big biotech stock at bars, and of course, Capstan. Safe to say, Leo's convinced he's got what it takes to be a full-time trader. So what does Leo do next? Well, he calls up his broker, makes up some numbers about his net worth, and boom, he's approved for options trading. 3 months later, and now Leo's all in on out-of-the-money Tesla calls, completely maxed out on leverage. His strategy? Buy high, sell higher. His risk management? Prayer. His wife's reaction? Why the heck is $13,000 missing from our savings account? Now, fast forward another 3 months. The Fed raises interest rates, and bam, Leo's portfolio drops by 67%. Meanwhile, his wife's new favorite search term is how to divorce a man who calls himself a market wizard. Which brings us to the burning question of today's video. Why do the dumbest investors seem to win? The answer is simple. The Dunning-Kruger effect is like Wall Street's version of survival of the fittest. It explains why clueless traders think they're the next Warren Buffett, why the smart ones think they're idiots, and why Leo's convinced that market manipulation is to blame for his options expiring worthless. Since 2020, you could have picked almost any random stock, and you'd likely have made money. If you're on the left side of the Dunning-Kruger curve, like Leo, you probably would have outperformed the S&P without even trying. Traditional investors? They focus on fundamentals and fair valuations. But the folks who've been making bank these last few years are buying companies at 650x earnings, riding trends that make pineapple on pizza look normal, and pumping their bags to anyone with a pulse. In fact, I believe it was Warren Buffett who once said, "Why bother buying Apple when you can invest in Fartcoin?" And if you take a step back, it gets even clearer. We've been living in one of the longest bull markets in history. 17 years of straight-up gains, with the S&P 500 soaring 715%. The market has basically been on a bleep noise bender since 2009. So over the past 17 years, pretty much anything you invested in would have given you a decent return. And because of that, riskier strategies, the ones that are a bit more irrational, have actually outperformed traditional investments. But let's be real, like all good parties, this bull run will eventually end. So the big question is, when's the hangover coming? And more importantly, how do you prepare for it? There are 2 ways you can go about it. The first option, you sit on cash like Warren Buffett has been doing. But let's be honest, that's boring. And you didn't sign up to compound at the risk-free rate. So that leads us to the second option. Keep going all in, and when the market inevitably turns, blame everyone else. You can point fingers at Jerome Powell, Donald Trump, or even market makers. Just make sure you have someone to blame, because admitting losses? Nah, that's not how investing works. And now, back to our original question. Why do the dumbest investors win? The short answer is retail investors love volatile, high beta stocks. Let's break that down. What is beta, and why should you care? Beta is a measure of how volatile a stock is compared to the overall market. Let's say Amazon has a beta of 1.33. That means it's 33% more volatile than the overall market. So if the market goes up by 2%, Amazon should rise by 2.66%. If the market drops by 2%, Amazon should fall by 2.66%. So why is this important? Well, when the market is up, a high beta portfolio, like the one Leo's got, will outperform the market. And there goes Leo, booking a reservation at Nobu, thinking he's the next George Soros. But when the market falls, a high beta portfolio feels the burn. And suddenly, Leo's wondering if Payway is hiring. In a bull market, Leo's high-risk, high-reward portfolio makes him look like a genius. But in a bear market, well, that same portfolio turns him into the next meme on Wall Street bets. So next time you hear your friend bragging about their 10x gain on some random meme coin, just remember, everyone's a genius in a bull market.